Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we are going to be analyzing Dollar General stock. This is one that I just bought recently, ticker DG. If you have a request of a stock you'd like me to take a look at, just put it down in the comments. I'll get the ticker on the whiteboard behind me and I'll make a video. If it's a stock that's in the S&P 500, I put those on YouTube for free. The rest are over on Patreon. And then I had a request. I made a video on Dollar General back in December, but I had a request from a Patreon member this weekend to see if I could do an update of that since I just bought it. I thought it was a good idea. So that's what this video is going to be about. As always, this is not individual investing advice. It's just how I analyze stocks. And I do have a link for Patreon down in the description. We have a free tier and a $5 tier right now. And I'm going to be adding some new tiers soon as well. And I also have a 25% off affiliate link for Fast Graphs, which you'll see me using, which will be pretty important for this particular analysis, I think, with Dollar General. So if you're interested in those, check those out down in the description. All right, Dollar General. So back in December, I made a video on this when it first declined. Let's see, was that December? I think it was December when I looked at it. So it declined and kind of started to come back a little bit. And I shared the price that I would be looking to potentially buy the stock. And that price was like $94, give or take. Now you can see that it's down about 83, which it did in like 1 day or 2 days or something like that. So it just kind of fell off the cliff after the recent earnings report. So I think, let's see, where to start with Dollar General. I kind of want to take a macro view first here. First, let's look pre-2018. First of all, we don't really have recession data for it, so that's important to keep in mind. But we do know that it's a dollar store, and that it, even though it hasn't been public since before like 2009, it looks like, we know that it's actually existed a long time. So it's gone through cycles before as a business, right? And survived and grown. And being a dollar store, in certain situations, it could be, I don't want to call like recession resistant, but there is a point where people will trade down to when money gets tight, if rather than spend money at a more expensive store, they might go to like a dollar store instead, right? So that's one potential outcome, and I'll get into that later. But for a lot of stocks, if I don't have any recession data, I just probably would just say they're too hard. It does make it harder to kind of get a historical valuation that might be good when you don't have actual data to look at. So it can make you, it just makes me always want to be like a little bit more cautious, which is one of the reasons why I took my time buying this one during this big decline. I was looking at it, right when it first started. I had people asking me about it during this initial dip, and I was like, hold off, and that has paid off now. So because the stock price is much lower. All right, so let's see. First thing, earnings growth has been very good up until like 2018, and then we get into kind of some weird years that are probably not, that are going to be atypical basically of what we can expect in the future. Because really the question we want to ask is, what are these earnings going to do in the future? And if I pay this price today, is that going to be a good price for what kind of earnings growth we think we can get? Important things to point out, I would say going into 2018, if you exclude the first couple fast growth years, they're growing like low teens to 10% a year, right? Pretty steadily. So we can just kind of call it 10%. And then we get into 2018 and we have tax cuts, right? So they have this big jump in earnings. That's mostly going to be attributed to tax cuts, corporate tax cuts. That growth isn't going to continue. The cuts will still be there, but you're not growing on it, right? You get the cuts that year, and then your earnings are kind of at that level, at that tax rate level. So this is kind of an anomaly that we can kind of scratch off. But if we look at 2020, we're back to the low teens, 10% growth rate, right, for earnings. That's right here. Then we get into the pandemic. Then things get more weird. We have, one, the pandemic. Two, it looks like they probably were able to stay open during some of that because their earnings jumped a lot in 2020. Then we have stimulus money. And one of the things that happened with the stimulus money is a lot of lower income people got a big influx of money that they didn't have, whether it was through child tax credit, whether it was through just, working or whatever, or having had worked and gotten that credit. There was a lot of individual stimulus money that got put into the economy. And those folks, lower income people, were able to spend more money at Dollar General. They just had more money to spend. And we saw this throughout, which is why we got inflation, because wages also went up and so forth and things like that. Well, nobody wanted inflation, or a lot of people didn't want inflation. So everybody's trying to get inflation down. Well, one of the ways you get inflation down is to make sure that low wage people don't get raises, right? And so we had about 3 years where the stimulus money and supply chains and all that stuff helped boost Dollar General's earnings. And there are a lot of businesses like this, and many of them had bigger boosts than Dollar General did. But the reason this is important is that it shouldn't surprise us that this past year earnings growth fell, that earnings declined. That was a stimulus bust, basically, and a pandemic bust, if you ask me. So it wasn't necessarily anything specific to do with Dollar General, but the market, because it can be dumb sometimes, had priced the stimulus money like it was going to go on forever up here. And it wasn't. So if we go back to 2020, they earned $6.73 a share, and then in last year they earned $7.55. Well, so earnings grew. They didn't grow very much, probably like just inflation, so it's kind of flat. But when you've built up like your system, like your inventory, what you're paying, your payroll, maybe the cost of like transportation and things that would go along, and rent, everything that would go along with like running a Dollar General business, when those costs have risen and you were able to support them when the stimulus money was floating around, some of those costs are still going to be there when the demand falls, and so your earnings can be disproportionately pushed to the downside. And so I think that's what happened last year. This is just kind of a correction of stimulus bust. It wasn't, in my opinion, it wasn't necessarily anything wrong with the business. But what we're getting into now, I think, is, first of all, right now they say analysts are expecting $7.12 a share. I think this is going to be down closer to like $6, or I think they had a pretty big range where the bottom was maybe like 5.5 or something, like pretty low, which is why the stock crashed. I think I'm assuming $5.75 of earnings for this year in my spreadsheet right now. So first of all, they hadn't recovered really yet from the stimulus bust, okay? And now we're getting into the early stages of like a recession, especially at least for the people that are shopping at Dollar General. The folks that are shopping other places and have a lot more money, it hasn't really gotten all the way there yet. Although if you look at like Lululemon or some places like that, you might see a little bit of other retailers and see some of that too, right? But Dollar General's customers have been hit pretty hard and gotten squeezed, and so wages aren't keeping up with costs anymore. Even though inflation's coming down, if a lot of that inflation is your wages, then it doesn't really help you because your wages aren't keeping up and unemployment is going up, right? So those are all like early recession. Now, whether we actually get into like a real recession, wider across the economy, across the economic spectrum, we don't know yet. The Fed's going to start cutting rates to try to mitigate that. Historically, they have not been very successful doing that. I think some people would say 1995 they managed to pull it off, but the truth is, like the other 8 or 9 times we've been in a similar situation, we have not avoided a recession. And then the situation is, well, how bad is the recession? How long does it go on? But the main point that I'm bringing this all up is I haven't seen anything so far that says, look, there's something fundamentally wrong with Dollar General business. There might be, but so far all this seems pretty explainable to me by external factors. Now, there's always like execution decisions that happen within the business itself that maybe they could have done something better, but the truth is we had a stimulus bust. Now we're going into the beginning stages of recession, especially for Dollar General's main customers. So that's not their fault. Now they have to react to that and adjust to that. And that's kind of what you're betting on if you're buying the stock now. You're betting on earnings, assuming earnings are going to be bad this year. And hopefully in the next couple years, maybe even next year, if there is a recession, earnings will still be bad. But over time, things will work themselves out and earnings will begin to grow again. So the reason that's important, the reason you might want to buy it now instead of waiting to see what happens, is the stock price has already priced a lot of bad news in here. A lot of people are bailing on the stock that owned it. This stock is down, and it's not like nobody owned the stock. It's in the S&P 500. The stock is down 70% off its high, okay? People are pessimistic. They think Dollar General is doomed. Pretty much, a lot of people do, right, as an investment. So that can be a good time to come in as long as it's not actually doomed. So, and I think that, I mean, you never know. So this is why I usually place small bets, like small weighted positions. But it's trading at a stock price of $83 now that it was at in like 2018, basically, maybe 2017. And earnings back then were $4.49 a share, or maybe $5.70. So in the same range. And so really the question is this decline just going to continue, or will it bottom out and recover at some point? So when you buy the stock now, I think the price is fine. The valuation looks fine. The question is, will earnings bottom out at a reasonable over the next year or two, and then will it recover in like a reasonable amount of time, like say 5 years? Usually it only takes like 3, but weird things happen and things can take longer. So I kind of view it as now the stock price can go lower. I don't know where the price will bottom. If earnings are bad for 2 years in a row, the stock price can definitely go lower over the short term. It's really what's going to happen with earnings like 2 or 3 years from now. And if they come back and the trajectory is back on growth again from wherever they bottom at, I don't see very much risk here, like to the downside over the medium term. There is a point, if a recession drags on, they pull customers, wealthier customers in that didn't used to shop there as much, and kind of ballast it out a little bit. I definitely think that's a possibility. Now, returns aren't going to be good for them during that period, but the question is what comes after that? Like what comes on the way out when the recovery happens? So I have a way that I go about trying to estimate this, where I use a recession metric, but I don't have a recession to look back on these guys. So I used a period where they had some weakness. I think it was like around here, 2012, 2013. So what I do is I look at the low price and the high earnings, and I create a PE out of that, and I call that the recession PE. I forget exactly which year that I did it with, but for most of these, that's going to be like a 14 PE. We can get in the spreadsheet and look. And then I say, if things kind of get pessimistic again, and the market treats it similarly, what would that look like, price-wise for the stock? Well, I would use the peak earnings, which are right here, 1068, and then the low price, whatever it's at, and create a PE out of that, and then compare it to where it was week previously in the past. And that's where I came up, and that I explain all that probably in my other video if you want to get into the details of it. But what it worked out to was like a little under a $95 buy price, right? Now, and I can look at those numbers actually to see what I have. So yeah, I have a 13.65 recession PE, and then my buy price is 20% higher than that. So I wonder what would happen if I just used this straight up, because I never try to like completely exactly bottom tick. I try to have a little buffer there, but now I'm a little curious since the price has dropped to see if this is close to where it's at now. So I'm going to take that 20% buffer out, and we're at 78. So without that, if you just use that metric, right, and try to bottom tick, it would be 78.89, which is kind of interesting. That's pretty close to where we are. But I usually try to buy a little sooner than that, because I'm not trying to like get an exact price when I do this kind of thing. What I'm trying to do is not buy it up here. This metric is what saves you from buying all during this decline, during this little bounce. It stops you from doing all that, because if you go back to my video, 8 months ago or 9 months ago, I had the same buy price that I have now, even though earnings have been getting worse and things, because it's static. You base it off the peak earnings, because what you're assuming is that earnings, even though they're declining right now, will eventually recover. Now the market's looking at the current trajectory. That's why the stock price is going down. You want to say, okay, yeah, when you have a recession and a stimulus bust, earnings are going to decline. That's what happens. But if we get through it, where are we going to be in like 3 years? So that's the idea behind it. Now, one thing you can do on fast graphs, when you have a stock kind of like this, instead of doing it my fancy way, is you can use their normal PE function here, which works pretty decent with this, with something like this. So if we take this time frame, well, maybe we'll take the whole one. I think it might be a little more conservative, actually. Let's see. Yeah, so the average PE over since it went public is 18.81. Now, that's this blue line on the fast graph. So when the stock price is below that, if you ever watch any of Chuck's videos, this is one of the main metrics that he uses. I kind of stopped using this recently, because using it as a standard practice, because the interest rate situation was so different than when it was in the years leading up to COVID, right? We had almost 0% interest rates, and bonds and cash yielded nothing. So I became a little cautious about assuming that we would get back to that similar type of environment, because really what you're doing is you're saying, look, in average times, this is what the market usually treats this as a PE wise, is like 18 PE. So if it dips below that down to like 15 or 16, that could be a good time to buy. And then if you hold until it gets back to average, you can make some money. So if we do that now, let me see if I can draw a line. Yeah. So if we do that now, and I'm going to move these a little bit. Maybe this one won't move. Okay, but if we go 2 years out, this is projecting to 2020, the end of 2027. If earnings do what analysts currently think they will do, which is partially recover, up to like in between $8 and $9 a share, I think. That's not even quite a full recovery, but partially recover back to where they were, and the stock trades at an 18.81 PE, that will be a 100% profit, right? That's the setup in the bull scenario, basically. Now, so let me actually give you those numbers since they were covered up. But yeah, so that's the market assuming like a $9.07 in earnings on 1/27, January 27, and so that's gonna like double earnings probably from what they are this year, or we'll see. But if we come in between like $5.50 and $6 a share, it's gonna take a pretty big recovery to get to 9. So, and then you imagine that trajectory actually changes, the earnings trajectory, the stock price will dramatically usually come back. And so that's how you can get a double in your stock price, which I've done with this strategy a lot. I bet at least like 20 stocks that are set up just like this, most of them from March 2020, that I got doubles pretty quickly out of. So now, again, if there's a recession, if it takes longer, that's fine. But this is the bull kind of case, right? You probably have, if they recover, if earnings-wise over the next 3 years or so, even if it was 4 or 5 years, you're kind of looking at like a 100% return if things return to kind of quote-unquote normal. And so then it's a matter of time, well, how long does it take to get to that 100%, give or take? During March 2020, and some of them it only took like 6 months, but that's not normal. Normally, if you go back to the Great Recession, it definitely took a lot of stocks, more like 3-4 years, maybe 5 years. It just kind of depended on which business they were in. But something like this, I think the risk, you could lose money definitely over the next 3 years if things don't go well. But it doesn't seem to me like it seems definitely the risk reward is okay. Maybe in a bad scenario you lose 20 or 30% and it doesn't work out over the next couple of years. But in the bull case, you're doubling probably. So that risk reward looks pretty good here, and you really don't have to do much work. You just kind of buy it, place your bet, which is what I did on Thursday or Friday. I think it was Thursday when I bought it. You place your bet, which I think should be like a 1% portfolio weighted position. So if you have $100,000, and that's like $1,000, right? It's not that much, because there'll be other opportunities like this that will probably come along too. We're seeing Ulta Beauty, Lululemon, or a couple more that are on my list back here that are kind of in a similar situation. So rather than put everything on Dollar General, you're going to see some of these same dynamics with other businesses, and you can kind of, as they hit the prices, buy. You get your bets kind of spread around, and then hopefully the cream will kind of rise to the top, and you get some good returns over the next like 3 to 5 years. But once this one's purchased, the way I view it is that bet's placed. Wait 3 years, see what happens. We know assume this year will be horrible, and then next year could be bad. And then when you get into 2026 or so, then you kind of need to reevaluate and say, okay, you have to look in the macro and everything. But by that point, if they're going to come back, we should start to see some signs that things have leveled off, that they're starting to climb back, and then you just kind of wait for that process to play out. So that's where I'm at on Dollar General now. I'm glad I was able to share my buy price early, well before it, which was my buy price for a long time, even before I made that video. And sometimes I'll share these after a stock drops like 20%, like here, and people will tell me I'm nuts and they'll never get that low. But you can see that they do get that low sometimes. And when they do, the important thing is you don't change your mind and get scared and not buy. I just come in and make the purchase. It's cheap enough now. Doesn't mean it's going to be right necessarily, but you get the odds on your side. All right, if you found this useful, hit the like and subscribe buttons. If you have a request, put it down in the comments. I'll get it on my list and I'll make a video for you. Later.